Right, let me show you why I think gold can still go a lot higher from here. Now, I'm not talking about a particular geopolitical scenario. I'm talking about a particular setup that I think the market should start pricing soon. And you can see a hint right here, because when you remove all the noise away, and obviously nowadays there's a lot of noise because of the geopolitical tensions, obviously, the story is actually pretty simple. The labor market is starting to flash once again some warning signs. And at the same time, energy prices are rocketing higher, obviously, because of what's going on in the Middle East. And if that continues, you've got slower growth with quite a sticky inflation because of energy prices. And this is the kind of environment where gold makes a lot of sense. So let me walk you through how I'm thinking about it. The labor market is vulnerable. You can see that. Obviously, the latest NFP data and unemployment rate is quite concerning. Obviously, the headline NFP is particularly more concerning, but also the unemployment rate is ticking high. Still at normal levels, ticking higher once again. Now, on its own, this already matters a lot for gold. But what makes this even more important is what's happening at the same time on the inflation side. This is where the setup gets really real, okay? While the labor market is vulnerable, and you've seen that with the latest employment data, this is the chart that scares every central bank right now. Energy prices, you can see oil right here, but all sorts of energy prices are starting to get pretty elevated once again because of the geopolitical reasons. Well, this adds a whole other layer of complexity to the picture, because energy prices feed into what? Inflation, particularly headline inflation, and they go to directly hit the consumer, okay? Now, the point is that it raises the price of everything, while at the same time, as you've seen, the labor market is in a vulnerable spot. And so the market now is dealing with two pressures at once. On the inflation side, we got CPI that it's most likely going to tick higher once again because of what? Because of energy prices, okay? You can see the correlation between headline inflation, core inflation as well, and oil prices is pretty remarkable, because obviously inflation gets dictated a lot by energy prices. And so inflation, once again, may be ticking higher again, while at the same time, growth, the unemployment rate is ticking continuously higher. So this is where things get pretty uncomfortable, because policymakers here start to get boxed in. Because think about what the central banks now needs to do. They cannot comfortably support growth if inflation is still a problem. So growth is sticking lower, the unemployment rate is sticking higher, there's this vulnerability, but at the same time, inflation risks are high, while they can't support growth enough, because they also need to think about inflation. But at the same time, if growth is vulnerable, if the labor market is weakening, they cannot fully fight the inflation side. And so that's the trap. This leads to an important scenario where inflation is likely going to rise, catching up with oil prices. Obviously, if energy prices stay elevated, because you can imagine the whole story changes quickly if suddenly the situation resolves itself and oil prices fade back down to pre-event levels. Well, that's a different story, and that's the risk to the view. But let's say that the disruption to the energy market continues for some weeks and prices stay elevated. Well, that's a problem, because inflation will inevitably pick up. But at the same time, the Federal Reserve will not be able to what? They will not be able to hike as much as they should. So rates will not go higher as much as they should. As a result, real yields will move. Overall, it's not going to be straightforward, but overall, they're going to move lower, because inflation rises, but rates don't catch up with inflation enough. Now, if you have no idea what I'm talking about, I've explained already in detail how this all works in the full guide that I've made about gold's fundamental analysis. If you watch that, you know gold tends to do well when the market begins to realize that policymakers may not have a clean way out, they're just boxed in. That's basically the stagflation setup. And I know people throw that word around too casually, but in simple terms, that's what it means. Growth is vulnerable, inflation is too high, and the central bank is boxed in. They cannot do what they should be doing, okay? Slower growth, high inflation, policymakers stuck. Now, all this said, I always think that it's important to stress test the thesis, because if you don't, you end up getting attached to a view and you don't know the risk to the view. And so usually that happens that the market then humbles you because you don't know how to react if the situation changes. So the main counter argument is simple. The risk to this whole thesis is simple. If the energy price spike fades back away quickly because the geopolitical situation resolves, the Middle East comes down and oil flows through the region, oil prices move back lower. At that point, stagflation fears will disappear. Now, that means I'm not saying the bullish case for gold is completely risk-free or guaranteed. Obviously, it isn't, because there's nothing that's guaranteed in trading. We just trade the probabilistic scenarios ahead. If A happens, then B happens. Okay, so if energy prices stay high, if the Fed cannot hike rates as they should, then gold will move higher. But if the situation changes and, scenario C takes place, the geopolitical tensions get removed, then we got a whole different scenario in front of us, okay? But as of right now, scenario A is the base case scenario, the one that I think would most likely play out. So slower growth, persistent inflation. That's the stagflation risk again. And this is exactly the kind of backdrop where gold tends to do really well. So if you follow us, you know very well how we operate. Fundamental for direction, technicals for entry. First, we understand the macro narrative, which is the one I've just explained you. Then we go to the chart and we wait for the technical trigger that tells us the market is actually ready to pay attention to the narrative, because you don't want to fall into this trap where, things look super bullish, and the macro narrative is bullish for the asset, but you get in at the wrong price, the market pulls back a little bit, stops you out, and then guess what? The market moves in the expected direction. You have to look at the chart and you have to align the entry with the technical timing, because one thing is having the right view, and the other thing is actually having the right timing to get into that view. And in this case, there's actually a very clean structure on the chart. You can see this resistance, this confluence actually of resistance trend lines, which are starting to break out. So in my opinion, once that structure fully breaks out, it starts to hold above, then this is going to open up room for the next leg higher. So the way I see it is pretty simple. The macro backdrop is supportive. Stagflation risks are real. Real yields are most likely going to overall trend higher. Now I'm going to say it's not going to be straightforward. There's going to be spikes in real yields because the situation being tense, the market needs to actually understand exactly how to read the fact that the labor market is weakening and energy prices are rising at the same time. So there's that. But overall, real yields are likely to move lower, and so gold is likely to trend higher. Now, at this point, we just need the chart to confirm that the market is ready to move towards the macro direction. Okay, that's the part that I'm watching. Once it fully breaks to the upside, in my opinion, will clear the way for the next move higher. So that said, if you want more videos where I explain in real time the macro side of these markets in a way that's actually usable, well, like the video and subscribe to get more of this.